Back to intermediate accounting, and video is the first part of Chapter 19, Accounting for Income Taxes. This video is going to cover the fundamentals of accounting for income taxes. Everything that we do in Chapter 19 stems from the fact that GAAP, Generally Accepted Accounting Principles, the set of accounting rules used by publicly traded companies in reporting their financial statements, those rules are very different than the rules used by the IRS in preparing tax forms. So that leads to the fact that income tax expense that we see on the income statement under GAAP is very different than the income tax payable, the bottom line that you would see on a tax form, to the IRS. And so how do we account for those differences? That's what we're going to learn about in this video. Again, what we see on the financial statements over here on this side, on the financial statement side, we have the purpose is to have a set of consistent rules for SEC filers, for publicly traded companies, to give this information for investors and creditors. We use the terms under financial statements. This is also known as the GAAP reports, Generally Accepted Accounting Principles, and sometimes we call this the books, or simply book amounts. We use the terms pre-tax financial income on the income statement. Sometimes we call this income before taxes. They mean the same thing. And then we take the income before tax, we multiply it by some estimated tax rate, and then we get our income tax expense on the income statement. We're going to see some slightly different wordings when we think about what information is on the tax return. Now, this class is not going to cover the details of the tax rules set by the IRS that you take the tax class to go over. But what we want to introduce is these two terms, taxable income instead of income before taxes. This is the wording that would be used on the tax form. And then that taxable income times the applicable tax rate gives us the term income taxes payable. This is the exact amount that we owe to the IRS. Well, then this income tax payable account is then reported on the balance sheet. But what we can see here is if a different set of rules is determining pre-tax income than taxable income tax expense on the income statement is going to be different than the amount of taxes owed to the IRS. And that's what we're going to start by covering in this video. Let's take a look at an example. Chelsea Inc. reported revenues of $130,000 and expenses of $60,000 in each of its first 3 years of operations. So when we're talking about reporting revenues and expenses, we mean this is the book income. This is book or GAAP. For tax purposes, because tax rules are different from GAAP, Chelsea reported the same expenses to the IRS, but the revenues were different. So what can we infer by this? If Chelsea's reporting revenues of $130,000 in year one and $100,000 in year one under tax, that $30,000 difference must mean due to year one or year 2020. There was a sale on account, so we know that accounts receivable increased $30,000 because if we have a sale on account, we recognize that revenue under GAAP. But under the tax rules, we look at the cash revenues, not the accrual revenues. So that $30,000 was not included in 2020's revenues. That $30,000 was collected. Some of it was collected in 2021. Let's assume that the next period's revenues were all collected in cash of the $130,000, plus the company received, so accounts receivable in year 2021, accounts receivable must have went down $20,000. Because the company received the full $130,000 plus an additional amount of cash that wasn't recorded as revenues. And in year 2022, the remaining $10,000 of receivable was collected in cash, causing our taxable income to be higher, $140,000, than it was $130,000 under GAAP. Let's move along in this example. Let's take out our pens and pencils and start and our notes here, and let's start doing some calculations and some journal entries. Here we see what the income statement according to GAAP would look like for each of the 3 years where we see revenues under accrual accounting being $130,000 every year. We also see the expenses of $60,000 every year. Then we see what the tax form would show. Revenues on a cash basis, $100,000 in year one, $150,000 in year two, and $140,000 in year three. with the exact same expenses. Let's look at how this difference in when the timing of the revenue recognition with book versus tax or GAAP versus tax results in a difference between income tax expense under GAAP versus under tax. So in 2020, we have pre-tax income of $70,000 in year 2020, $70,000 in year 2021, and $70,000 in year 2022, for a total pre-tax income of $210,000. We're told that income tax expense for this company is 20%. So if we took $70,000 and multiplied it by 20%, our income tax expense in each of the years would be $14,000. Again, this is just the $70,000 times the tax rate of 20%. And over the course of the 3 years, our total income tax expense, 14 plus 14 plus 14, is a total of $42,000. If we were to add up the total revenues, we would see $390,000. What if we added up the total revenues under the tax form? Again, we see $390,000. So all this is a timing mismatch between when we're recognizing the revenues under GAAP versus under the tax reporting. Taxable income under tax reporting under the IRS form would be $40,000 in 2020. And if we multiplied that by 20%, we get income tax expense of $8,000 for tax purposes. This is the amount we actually have to pay the government of $8,000, but our income statement is showing that our tax expense based on our accrual or GAAP numbers is $14,000. So what do we do about that difference? That's what this video is going to cover. Year 2021, we see that taxable income is $90,000. At a tax rate of 20%, we are actually going to owe and pay the government $18,000. In year 2022, taxable income is $80,000. Multiply that by the tax rate of 20%, and income tax expense is $16,000. Now, if we add up the total taxable income, that's the term that we use in the IRS forms and for tax purposes, we see that the total amount is exactly the same under book and tax. Income tax expense, if we sum up how much we owe the government in each of the 3 years, we're going to get to the exact same amount. It's just a timing difference. So what do we do about this difference between what we see on the income statement of $14,000 for year 2020 and the amount we actually owe the government in 2020, $8,000? Well, these differences in each of the 3 years, we know that it's $6,000 in year 2020. It's going to be negative $4,000 in year 2021, and it's going to be negative $2,000 in year 2022. We start with what is it in this current or first year? $6,000. We're saying that our expense on the income statement is for income tax expenses $14,000, but we only have to make a cash payment of $8,000. What do we know? We know that in the future we're going to have to pay this additional $6,000 to the government. It just wasn't taxed this period. It will be taxed in the future. And so because we are going to owe more to the government in the future, we set up a deferred tax liability. So in year 2020, the deferred tax liability account increased to $6,000. The difference between the amount of income tax expense on the income statement based on book revenues and expenses and the actual amount of taxes that we owe based on IRS rules. The next year, our revenues for tax purposes were higher, so we owe more. So we are going to reduce that liability by $4,000. We see that negative here becomes a reduction here. And then we're going to reduce that deferred tax liability by $2,000 in year 2022, so that over the 3 periods, that deferred tax liability is 0. So we're establishing this timing difference between when we're recognizing income tax expense on the income statement and the amount we're actually owe and are going to pay to the government. What would this look like on the financial statements? Where would this deferred tax liability get reported? Of course, it would be in the liabilities section. We would have deferred taxes or a deferred tax liability of $6,000. at the end of 2020. That relates to this $6,000 that we have here. And then what else would we have? Well, assuming we didn't make that cash payment at the exact end of the year, but we're calculating this under book or GAAP purposes, we are going to also record income taxes payable. This is the amount we will need to pay to the government. And you'll see that this total on the balance sheet is the $14,000 that we see under the income tax expense for book purposes. Will we see on the financial statements? On the income statement, we're going to see income tax expense. Remember, that was our pre-tax income multiplied by the tax rate of 20%, and that income tax expense was $14,000. Let's take some notes here. About future taxable and deferred amounts. A temporary difference is the difference between the tax basis of an asset or liability and its reported, also called carrying or book amount, in the financial statements that will result in either more tax in the future, meaning taxable amounts, or less taxes in the future. We call that deductible amounts in future years. Let's fill in these notes here for future taxable amounts. That's the case that we saw in the last example, deferred tax liability. Deferred tax liabilities represent the increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the current year. It could have worked out the other way, that our book income had been lower than our taxable income. In that case, instead of setting up a deferred tax liability, we would set up a deferred tax asset. That represents the increase in taxes refundable, in other words, or saved, taxes saved, in future years as a result of deductible, rather than taxable, deductible temporary differences existing at the end of the current year. In the example we just saw, the only difference between the book basis and the tax basis of the assets and liabilities, it just related to that accounts receivable, one sale on account. The company reported accounts receivable at $30,000. That's actually what we can use to determine the deferred tax asset and the deferred tax liability. We can look at that change in the difference in the account receivable to then determine what should our deferred tax asset, or in this case, deferred tax liability, look like. And here we see the $30,000 account receivable, increase in accounts receivable in year one. It decreased by $20,000 in year two, and it decreased by the additional $10,000 in year three. Again, a deferred tax liability represents the increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the year. Because it is the first year of operations for Chelsea, there is no deferred tax liability at the beginning of the year. So let's look at what we saw earlier. When we saw these difference between the actual income tax expense, the 20% times pre-tax income under GAAP, $14,000 in the first year, and income taxes payable, IRS, of tax amount owed to the IRS of $8,000. Let me scroll down here. So we're just focusing on 2020. What would that journal entry look like to record income tax expense and the related deferred tax liability? So we know that we're recording income tax expense for book purposes. It was $14,000, so we're going to debit income tax expense. This is going to be an entry made at the very end of the year once the company finalizes its pre-tax income. We're not making the cash payment to the government just yet, so we are going to record income taxes payable for the amount that shows on our tax form that we owe to the government, which is $8,000, and that difference gets reported as a deferred tax liability. What about the next year? Let's continue with the same example. What would the journal entry look like at the end of 2021? We record income tax expense at the amount that we're showing on the income statement, which we said was $14,000, 20% of the pre-tax income. We want to record the amount of income tax payable that we owe based on our IRS form. And we're told that that was $18,000. And then what do we do with that difference? We know that we need a $4,000 debit to make this equation balance, this entry balance. Well, what are we going to do? We're going to reduce that deferred tax liability with a debit. And let's look at the entry in that last year, 2022. Record the income tax expense with a debit of $14,000. Same as each year. Record that income tax payable based on the amount on our IRS filing form, which we see here is $16,000. And then where do we book that additional $2,000 debit? It's the last reduction of the deferred tax liability. What would those entries to the deferred tax liability account look like? We started with the initial, in 2020, we started with the initial $6,000 credit to increase the liability, and then we reduced it over time. And at the end of the 3 years, as expected, the balance in the deferred tax liability account is going to be zero. What would the balance sheet and the income statement look like over this period? We know that the income taxes payable, this is the amount owed to the IRS. We were told at year end 2020 that was $8,000. In 2021, it was $18,000, and in 2022, it was $16,000. What is the deferred tax liability that we reported? Initially, we recorded the deferred tax liability of $6,000, and we reduced it by $4,000. So at the end of 2021, our balance sheet reports a balance in the deferred tax liability of $2,000. And then during 2022, we reduced it that additional $2,000. And at the end of 2022, we have no deferred tax liability. What would the income statement look like? Remember, we said every year for the income statement under GAAP, every year we had $130,000 of revenues and we had $60,000 of expenses. So every year we had $70,000 in pre-tax income, and we were always multiplying that by the tax rate of 20% to get a constant income tax expense each period of $14,000. So net income would be reported as $56,000 in each year, and this is on the income statement that investors are looking at. Remember, investors do not get to see those tax returns. Only the company will know those. Here's the income statement that we wrote out here, showed up again, the $56,000, and this is what the income statement would look like in a little bit more detail if we just take a look at any one of these years. We would see income before taxes or pre-tax income. We would actually separate out that income tax expense as the amount owed. This year, $8,000, and then here is that deferred tax liability showing up. That's the deferred tax expense. We looked at the liabilities, but what about if the opposite had happened in that first year? What if our income tax expense on the income statement or pre-tax income on the income statement had been lower than our taxable income on the IRS form? Then we would have a future deductible amount, which we refer to as or record on the books as a deferred tax asset. A deferred tax asset represents the increase in taxes refundable or saved. In future years as a result of deductible temporary differences existing at the end of the current year. Let's take a look at an example. Hunt Company has revenues of $900,000 for both 2020 and 2021. It also has operating expenses of $400,000 for each of these years. The company also accrues a loss and a related liability of $50,000 for financial reporting purposes because of pending litigation. Remember, we talked about how companies have to set up, even if they're not making the cash payment, if it's very likely to happen, the company is going to have to pay out, and it relates to something that happened this year. The company records an accrual, an accrued payable and a loss this period. But tax rules are more based on cash that's paid or received. The company cannot deduct this amount for tax purposes until it actually pays off that liability expected next year. So there's going to be a deductible amount that will occur in 2021. So what's going on here? Because of this additional expense, our book or GAAP income will be lower than our taxable income. So we're going to end up paying more to the IRS than we're showing as income tax expense on our income statement. And that's going to cause us to need, it's going to result in us needing to record a deferred tax asset. Let's take a look at what the financial statements would look like. We have the revenues and expenses. Remember the litigation loss we would report under GAAP in year 2020, but not in year 2021. That would cause our pre-tax financial income in 2020 to be $450,000. The tax rate is, again, we're using this tax rate of 20%. So income tax expense on the books or under GAAP or on our income statement would be $90,000 in year 2020. And $100,000 in year 2021. But what about under GAAP? We have the same revenues and expenses, but because we have not paid this out in cash in year 2020, we're going to record this loss in the following year, 2021. So our taxable income is now higher than our book income. And we see that this is going to reverse out the next year. This is just, again, a timing difference in a different direction than the last example we looked at. Hunt can compute the deferred tax asset by preparing a schedule that indicates the future deductible amounts due to deductible temporary differences. So we can say, what is the future deductible amounts? We know that it's going to be the $50,000. We know that next year we're going to be able to take that as a deduction on our taxes, or in other words, our tax income next year is going to be $50,000 lower than our taxable income is going to be next year. This is in all future years. We know it's just 1 year out. Multiply this by the tax rate of 20%. And this gives us our deferred tax asset at the end of 2020 of $10,000. Assume that 2020 is the company's first year of operations and that income taxes payable of $100,000, and the company had income taxes payable of $100,000. Compute income tax expense. Well, we're going to start this by looking at what was the deferred tax asset at the end of 2020. Deferred tax asset, we're going to abbreviate DTA, end of 2020. We know that that was $10,000. We're going to look at the difference between that and the deferred tax asset at the beginning, because really what we want is that change in the deferred tax asset. And we know this was a new company. They started in 2020, so it must have been zero. So this difference, this change in the deferred tax asset account, this is what we call our deferred tax expense for 2020. And this is going to be a negative. We're taking our beginning minus our ending, and this is going to be a negative expense, which really what we mean by a negative expense is a benefit in 2020. And we know that we have the current tax expense, or the amount that we actually owe to the IRS, was $100,000. So the total income tax expense that we're going to report on the income statement for 2020 is going to be $90,000. Hunt makes the following journal entry at the end of 2020 to record income tax expense, deferred income taxes, and income taxes payable. So just like we did before, we have income tax expense. This is the number we're showing on our income statement based on pre-tax income or GAAP. We have income taxes payable, the amount that we owe based on our IRS form. And that difference, as we know, is going to be recorded as a deferred tax asset. At the end of 2021, the end of the second year when this timing difference reverses, the difference between the book value and the tax basis of the litigation liability is zero. Therefore, there's no deferred tax asset on this date. So we need to reverse that out. Assuming that income taxes payable for 2021 is $90,000, compute income tax expense. So to calculate income tax expense, we can start with our deferred tax asset at the end of 2021, which is going to be zero because this has fully reversed. Compare that to the change in the deferred tax, calculate the change by comparing that to the deferred tax asset at the beginning of 2021, which we said was 10,000. And if we take the beginning and subtract out the ending, we get the deferred tax expense. And remember, if this number was negative, we would call it a benefit for 2021. But we're going to take the beginning minus the ending, and we're going to see that it's deferred tax expense in the year 2021. The current tax expense for 2021, this is also the same as income taxes payable. This is just the amount that we owe the IRS based on our IRS form is 90,000. And this we've now reconciled to income tax expense for 2021 of 100,000. That's the amount that we're going to report on the income statement. Hunt makes the following journal entry at the end of 2021 to record income tax expense, deferred income taxes, and income tax is payable. So as usual, we have income tax expense, the amount that we report based on pre-tax income on the income statement. We have our income taxes payable. This is what we're going to actually owe the government, and this will be a liability on our balance sheet until we actually make that payment. And that difference is going to be the reduction of the deferred tax asset in year 2. What would the financial statements look like? Income taxes payable in 2020, this is the amount that we owe to the government, 100,000 in year 2020, 90,000 in year 2021. We have a deferred tax asset of 10,000 in year 2020 and 0 at the end of 2021. It's fully reversed out. The income statement in 2020 has we're going to update this to include our litigation loss. So income before taxes, it was the 450,000. And then our income tax expense, we know that it's going to be the 90,000, the 450,000 times 20%. But we report that as current, meaning the amount that we're actually going to owe to the government, and then deferred. This is our income tax benefit, or deferred tax asset, gives us a total of 90,000. And then net income before taxes minus income tax expense, net income 360,000. And what would we see as our balance in the deferred tax asset at the end of 2021 after we recorded our journal entry? Well, we started off with recording the deferred tax asset as a debit of 10,000 at the end of 2020, and then we reversed that out with a credit of 10,000 at the end of 2021. And that concludes this introduction to income taxes, accounting for income taxes.